Hello, everyone. So my name is Federico Rivi. I'm an Italian Bitcoin journalist. We at Atlas 21, we do Bitcoin news, but we also provide marketing and communication services for Bitcoin companies. What do I mean with from BlackRock coin to digital cash? Well, another way to put it is this whole trend of Bitcoin treasury companies, penny stock companies, governments getting into Bitcoin as a reserve asset, private institutions getting into Bitcoin as a reserve asset, in some way deviating from the original vision of Satoshi Nakamoto, i.e. digital cash, medium of exchange. Let's find it out. I'll go pretty quickly in the first part because we all know what has been happening for the last couple of years, 2 years and a half. Now there's this whole trend again of the Bitcoin treasury companies. The first mover, as everyone knows, has been Strategy. They hold almost, supposedly, 600,000 Bitcoins. There are companies whose core business is no way correlated to Bitcoin that are starting to buy and already started to buy a lot of Bitcoins, such as Metaplanet, GameStop, and there are also other institutions, traditional institutions such as Cantor, that joint ventures with Tether, with Phoenix. They built 21 Capital in the US and other companies. Obviously, we all know that ETFs were approved at the beginning of the last year in the US. BlackRock, Fidelity, Vanguard, a bunch of big guys of traditional finance came into the space, starting to offering basically paper Bitcoin and buying Bitcoin for the reserves to guarantee the paper Bitcoin. In the Bitcoin treasury trend, now there's a new interest, supposedly, according to the Financial Times. Well-known crypto influencer wants to build his own Bitcoin treasury company, raising $750 million, according to the Financial Times. What could go wrong, right? But anyway, it's not only private institution, it's not only private companies, it's also government. As everyone knows, the US built a strategic Bitcoin reserve. God forbid that it could be like a proper strategic Bitcoin reserve. It's no way a Bitcoin reserve. It's another way of naming the Bitcoin that were basically stole through judicial proceedings. But anyway, what's the effect here? Obviously, there's no effect in the game of demand and offer of Bitcoin. There's no new Bitcoins getting bought from the US government, but it's a communication effect. It's trying to, in some way, legitimize Bitcoin at the eyes of Trump supported, I guess, by the US citizens in general. So there's a communication effect here. There's legitimization. That's the point. Not only the US, obviously. We at Atlas 21, we built a tool. You can visit it at adoption.atlas21.com/globe. It's a tracker of Bitcoin state adoption. You can select the country. There's a bunch of countries that have Bitcoin in their reserve. Even the little kingdom of Bhutan started mining Bitcoin through their hydro power electrical energy. So there's a bunch of countries who are actually using and starting to, in some way, promote Bitcoin as a store of value, as digital gold. And they're saying it out loud. This is a report from the Office of Debt Management, which is an office of the Treasury Department in the US, that stated primary use case for Bitcoin seems to be a store of value, aka digital gold. And this brings also, obviously, the mainstream media in the game. Even those mainstream media, those newspapers that were the fiercest enemy of Bitcoin. Look at Barron's or the Financial Times. Maybe Bitcoin is the new digital gold after all. And the title from the Financial Times is even more interesting. They say, can Bitcoin miners find a green way to dig for digital gold? From an agenda setting perspective, from a journalistic perspective, this is even more interesting because they use digital gold as a synonym of Bitcoin, just taking it for granted. And this is super interesting. But what was the original vision of Satoshi Nakamoto? Did Satoshi want to build a digital gold system? I don't remember the white paper being like this. The title wasn't quite like this. There's a bit of an error here. The title of the white paper, as Jack reminded us on Nostr a few months ago, was Bitcoin a peer-to-peer electronic cash system. But governments and big institutions want us to use it as digital gold. Why so? Well, it's pretty easy, right? They've tried to ban it. Look at China. I think they've tried like 13 times, for sure more than 10. I think 13 times trying to ban Bitcoin mining. They couldn't do it. Yet today, China is the second biggest hash power country in the world. They have the second hash power in the world after the US. They just couldn't do it. Government tried to ban Bitcoin. They just couldn't. So when you cannot do something, what can you do? What is the alternative? You try to control the narrative. And so what's the best narrative to let people use fiat currency, to let people use dollars, euros, yen, and so on? You let people understand and use Bitcoin only as a store of value so that people can just use fiat currency as a transactional technology, so they can use digital payments, digital euro, digital whatever, and they can be traced. You basically let people not use their privacy at all, not reclaim their privacy at all. What I want to argue today with you is that the game theory behind Bitcoin is fascinating, and it makes so that this kind of narrative, even if apparently goes against the use case of Bitcoin as a medium of exchange, in fact, it will lead us to use Bitcoin as a medium of exchange even faster, even if they say that it's just digital gold, for example. Let's see how this plays out. First of all, breaking news. Bitcoin is volatile. There's been a period of 15 days between the end of March and the beginning of April in which, against the US dollar, Bitcoin lost 50% of its value. And what is the function of cash? I'm not an economist, so I let the words of Ludwig von Mises speak for me. He wrote this in The Theory of Money and Credit in 1912. A medium of exchange whose purchasing power is subject to frequent and sharp fluctuations cannot provide full satisfaction of the requirements of an ideal money. That means that if you get 100 euros today, you want those 100 euros to buy the same amount of groceries that they will be able to buy in 15 days, in 30 days, in 60 days, in 6 months' time. You want your money to let you plan for the short and medium term, ideally, even in the long term, but we know that with fiat currencies this is not possible. You want to plan your life in the short and medium term with cash. And so this brings us to the very first harsh truth of this talk. Don't throw bananas, but nowadays the euro and the dollar are a better medium of exchange than Bitcoin. And I'm not talking about us. I'm not talking about activists. I'm talking about the broader audience, the world outside. It's easier to plan in the short term with the euro and the dollar than with Bitcoin. But there's a good news. They have been, until now, and as of now, better medium of exchange, because there are two things that are happening right now at the same time, and they involve fiat currency and Bitcoin. Let's start with the first one. So this is, again, Congressional Budget Office, the office of the Treasury Department that we met before. And this is the US debt to GDP ratio chart that was published this year by the Congressional Budget Office. You can see that the projection is not super good for the US debt, for the US dollar, for the US economy in general. It is projected to reach more than 150% by 2055. But let's focus on the period that interests us, the period in which fiat money basically lives, from 1971 until now. Now, let's remember this chart for a few seconds. We'll get back there like in 20 seconds, and let's look at this chart. This chart is the US dollar purchasing power from the 1910s until now. And let's do the same thing again. Let's focus on the very exact same period. This one. And now let's compare the two lines. So, no. This one. Let's compare the two lines. This one is not from the 2000s, it's from 1971, but it's okay. There's a pattern here. The more the ratio between debt to GDP grows, the more the purchasing power decreases. What does it mean? It means more debt, less purchasing power, which means more debt, more inflation. And do you remember what was the projection of the Congressional Budget Office? By 2055, 150% of debt to GDP ratio. So the more the time goes on, the more debt the US gets, the more inflation grows. So, sorry for the spoiler, but this is the next truth. Inflation is here to stay. Well, it's here to increase. Because what you've been told, the 2% inflation target, is complete bullshit, pardon my French. Every economist, every economics professor, every commercial banker, every central banker knows this. If they don't know, they're not good at their jobs. Let's hear it from the words of the very biggest central banker in the world, Jerome Powell. Can we hear it? Guys? Volume?
It's I guess it's
let's
obvious.
Let's start from the beginning.
For the general public, those working families of people, why 2%? Why is getting it to 2% so important?
So that has become the globally agreed, essentially all major central banks target 2% inflation in one form or another.
How does that help my Nevada families? How does that help people in Nevada?
I'll tell you how it does. And it's I guess it's obviously not it's not obvious how that is, but what 2% inflation, to have people believe that inflation is going to go back to 2% really anchors inflation there, because the evidence is and the modern belief is that people's expectations about inflation actually have an effect on inflation. If you expect inflation to go up 5%, then it will. If everyone kind of expects that, because that's what businesses and households will be expecting, and it'll kind of happen because they expect it. So having a 2% inflation goal, which we had for many years, de facto we had it, then we formally adopted it in 2012. But for years before that, we were effectively targeting 2% inflation. And what that meant was that inflation, it's one of the reasons why inflation was low and predictable, is having a real target and sticking to it, not changing it at convenient moments.
That is the rationale behind the 2% target. If you expect inflation to go up 5%, then it will. Magic. There is no rationale behind the 2% inflation target that some economist is already saying out loud. This is Jason Furman, economics professor at Harvard. He published an article on the Wall Street Journal in 2023. The Fed should carefully aim for a higher inflation target. And then our loved Paul Krugman commented right away, I agree with Jason Furman's call for a 3% inflation target. The rationale for 2% has been overtaken by a couple of decades' experience. The couple of decades' experience is more debt, because if the States doesn't get more debt, it goes bankrupt. So the 2% rationale has been overtaken by the fact that if inflation stays 2% for the next 20, 30 years, all states in the world go bankrupt. That is the reason. And it's kind of clear, even in the numbers. Again, Congressional Budget Office. Let's focus on the second and on the fourth point. Annual deficits will grow from 6.2% of GDP in 2025. Obviously, we are talking about the US, the biggest economy in the world, not about Uganda or whatever, to 7.3% of GDP in 2055. That means that every single year the US will have to borrow 6% of the GDP more that they get from income taxes and whatever, just to stay alive, just not to go bankrupt. Last point, interest cost. Guys, not debt, interests, only interests, will reach a record 3.2% of GDP this year, 2025, exceeding the cost of defense and Medicare, and further grow to 5.4% of GDP by 2055. This means that the interest cost will be the biggest voice of expenditure in the US budget, more than the military and more than Medicare. What's the result? That the average interest rate on debt will exceed the economic growth rate by 2045, sparking the beginning of the debt spiral. How does this work? Well, the amazing Lynn Alden will say nothing stops this train. I like to call it the snowball effect. When the interest expenditure is already that high, you cannot cover it with the revenues, the taxes. So you have two solutions. Declare default, go bankrupt. You have to shut down public services. That is politically extremely unpopular. I mean, it happened in the history of the world. Argentina did it multiple times. Obviously, if the US go bankrupt, it's kind of different. But you have an alternative with easy money. You have more debt. You have the alternative of creating more deficit. How does this work? More deficit is created by issuing more bonds. If we're talking about the United States, likely 10-year treasury bonds. But treasury bonds, interest on treasury bonds is decided by the Federal Reserve. And usually, interest is quite low. So if the private market is not interested in those bonds, who buys these bonds? The only institution in the freaking world that is not allowed to go bankrupt, the central bank, the Federal Reserve. They print new virtual money, they send it to the Treasury Department, and this is called QE, quantitative easing. They literally buy the debt of the Treasury with new money. And what's the effect of this? The effect of this is inflation growth, because new money enters the market, and interest increase, because there's new debt on the market. And interest increases the interest expenditure, and so on. This is the snowball effect, and as Lynn Alden frames it, nothing stops this train. So the more we progress, the more public debt we will have. The more public debt we will have, the more inflation we will have. US dollar, the strongest fiat currency in the world, will get inflated more and more, gradually, not like in 2 years' time. It's going to be very gradual, but it's going to be inevitable. Meanwhile, the second thing is happening. Bitcoin hit $2 trillion market cap last year, and it's becoming one of the biggest assets in the world. Why so? Because institutionals enter the market, as we saw before. What does this mean? More investments, greater capitalization. Greater capitalization and more liquidity. With more liquidity and more capitalization, you have less volatility. It's pretty obvious. If you invest $100 in an asset that has a market cap of $1,000, or $100, for example, $1,000, you have a 10% volatility there. But if you invest $100 in an asset that has a $1 trillion market cap, the volatility is like 0.000000000 something percent. The market doesn't move. So more investments, more capitalization, more liquidity, less volatility. And obviously less volatility means also that you attract those investors who are less keen to invest in risky assets. And that's what basically has been happening since the beginning of Bitcoin. This is from 2011 though, but from 2011, this is the median volatility, 30 days volatility against the US dollar of Bitcoin. From 2011, we were like in 30 days, 16% volatility. Now we are at a median rate of 1.78%. And this trend is inevitable, again, if more investment gets into Bitcoin. So let's revise what Mises said. medium of exchange, whose purchasing power is subject to frequent and sharp fluctuations, cannot provide full satisfaction of the requirements of an ideal money. But we cannot expect to use an ideal money, a perfect medium of exchange, if we first don't make it become a reliable store of value. Because how does the money get formed? The good money forms in this way. First, store of value. Second, medium of exchange. And third, last, unit of account. Where are we today? Here. We are not even a reliable store of value because we use Bitcoin in our niche. Guys, we are a bubble. No one gives a shit about Bitcoin out there. We are a freaking bubble. We cannot talk about, obviously it's a store of value for us because we understood the purposes, the values behind Bitcoin, but the market tells us that we are super freaking early. We call it digital gold. Gold is like 10x the capitalization of Bitcoin. We are super early. This is a marathon, guys. This is not a sprint race. And so, don't get me wrong. Again, I am completely aware of the fact that institutions are trying to adopt the narrative of digital gold because they want us to use fiat money. And I want to quote my dear friend, Francis Pouillot, in his The Half Path article in Bulls Bitcoin blog. Make no mistake, the core principles of Bitcoin self-custody, censorship resistance, and privacy are under attack, and they truly are, from governments. But he also writes on X that Bitcoin's main use cases are digital cash, because it's a better asset, and digital gold, because it acts as a store of value. So what I want to tell you guys today is stop fighting. Stop fighting between those who want just to hodl and between those who want to spend Bitcoin. Because digital gold and digital cash are not opposites. In fact, digital gold is a function of digital cash. Digital gold is a prerequisite of digital cash if we want Bitcoin to get used from the whole world and not just from Bitcoiners or passionates or whatever. The economic incentive of using Bitcoin as digital cash comes if it first becomes digital gold. And this is the beauty of Bitcoin. It turns enemies of Bitcoin in our strongest allies. Because those institutions that I spoke about before are not our allies. They are fiat fucking bros. They don't care about Bitcoin and self-custody and privacy. But they do care about getting you buy maybe some paper Bitcoin. And so they completely changed the narrative. Look at Larry Fink. In 2017, the CEO of BlackRock was calling Bitcoin an index of money laundering. Nowadays, in an interview to Fortune, he's telling everyone that Bitcoin could replace the US dollar as the world's reserve currency because of what? Of national debt. So, we are using Bitcoin as a Trojan horse. Alex Gladstein said it out loud. He said, Bitcoin is a Trojan horse for freedom. And I cannot agree more, because by attracting those institutions and by attracting their narrative as digital gold, we are fueling new capitals into Bitcoin. And obviously, we can say we don't give a fuck about institutions, and we're right. We can use Bitcoin as of today as a medium of exchange, but we cannot expect the broader public to use it as a medium of exchange if its volatility is higher than the dollar's inflation. So it's not a matter of if, it's a matter of when. Bitcoin will become the best medium of exchange in the whole freaking world when its volatility will trend lower than the dollar's downwards volatility, i.e. inflation. Is it going to be in 5 years' time? Is it going to be in 15 years' time, in 30 years' time? I don't know. I'm not a magician. But this trend, these two trends are inevitable. At some point, these two lines will cross. And there will be the economic incentive for everyone in the world to use Bitcoin because it allows to plan better in the medium and short term compared to the dollar, and even in the long term in the case of Bitcoin. So this kind of Trojan horse game theory thing that Bitcoin allowed will allow us to transition from the US dollar standard, the fiat standard, to the Bitcoin standard. And what is the effect of the transitioning from the dollar standard to the Bitcoin standard? I think one of the most beautiful effects has been framed by Marty Bent from 1031 Capital. And it states, the kleptocratic state is going to die with a whimper. Thanks to open source software and P2P distributed cash, i.e. Bitcoin, people are slowly but surely picking the locks of the chains that parasite class has thrust on them. They don't know it yet, but freedom is going to win. Thank you.
Secure your BTC Prague 2026 ticket at the lowest possible price now.